Welcome to our first Chapter 8 video, T8A, which provides an overview of gains and losses. We've discussed gains and losses previously, but now it's time to get serious. We've discussed Chew in the past. Recall that Chew bought a stock for $100 and sold it for $140. And we know that Chew only recognizes $40 of income due to that wondrous concept of basis. That was our very first gain, or at least one of our first gains. And we know that Chew recognized a gain because she sold the stock. This is because the sale represents a realization event, a transaction in which significant ownership rights are changed. In this case, the stock changed hands entirely. That's a pretty significant change in ownership. When we have a realization event, we generally will trigger a realized gain or loss. A realized gain or loss comes from two important tax concepts: the amount realized and the adjusted basis. And the amount realized minus the adjusted basis is the realized gain or loss.
Learn it, know it, live it.
Let's begin with the amount realized. This is not the same as the gain or loss realized. They just both happen to have the word realized in them. A simple way to think about the amount realized is, what did you get? A more elegant definition is cash plus the fair market value of any property received, plus the assumption of any liabilities, minus any selling expenses. Yeah, like I said, what did you get? Adjusted basis is something we've already discussed. It was a critical element when we considered cost recovery in Chapter 7. So we know that a sale is a realization event. What else might be a realization event? Exchanges and dispositions are realization events. They come with many names, such as trade-ins, condemnations, thefts, and maybe lesser known, like something like granting an easement. Okay, let's be clear about this. Gains and losses do not equal cash flows. Let's read this example. Okay, let's calculate the realized gain or loss and the recognized gain or loss. First, let's consider pre-tax cash flows. Aztec is going to receive $40,000 in cash, $10,000 of marketable securities, and is going to have to pay $5,000 in selling expenses. However, in accounting for the amount realized, Aztec also needs to include the debt relief by Mayan of $70,000. Thus, we have an amount realized of $115,000. The adjusted basis was pretty straightforward, $100,000, resulting in a realized gain of $15,000. Aztec will owe taxes on the long-term capital gain, but recall that corporations do not enjoy a preferential rate and will pay at the flat 21%, at least in 2018, for taxes of $3,150. This leaves after-tax cash flows not of $11,850, which is the gain less taxes, but rather the pre-tax cash flows of $45,000, less taxes, or $41,850. Some finance folks might add the debt relief as cash, but that's a debate we'll just leave to them. Sadly, it is also true that a realization event can result in a loss. In a simplified sale, if Aztec sold the land for $85,000 cash only, the amount realized is $85,000, the adjusted basis is $100,000, and a $15,000 realized loss results. Just as a reminder, a realized gain or loss is not the same as a recognized gain or loss. That last comment is an important one. Now, it's true that many realized gains and losses are also recognized, but not all of them. For example, personal losses are generally not deductible, whereas personal gains are included in gross income. We're going to start to unpack these issues more in the next few videos, but this is the end of video T8A. So thanks for watching.